Hello trade pros, what is the VIX? Victorio is going to be doing a quick video with you today to explain to you how to apply the VIX and what it means. Simply said, the VIX is the volatility index and it measures the fear of investors in the market in the S&P 500 stock index. Victorio will explain to you in a little bit more detail and give you an options example of how you could profit from volatility. Let's jump into this video.
Hello YouTube, it's Victorio from TRADEPRO Academy once again with a video for you guys. Today I'll be talking to you about the VIX, what it is, and how to trade it. So in front of me right here, guys, you can see this is TradingView. We have the VIX ETF open. So the VIX is a volatility index that measures the market expectations of implied volatility on the S&P 500 options. So it's derived from the SPX. The VIX increases on higher volatility and drops off on lower volatility. So here's a perfect example, guys. The VIX went from 12 all the way to 50, 51 in February when we had those huge market moves and that massive volatility that came out, if you guys recall. And in the summer, it tends to drop off back into these 12 to 10 zones and stays a little quiet because summer, there's not really that much volatility. So right here, we have the VIX in correlation with the S&P. So right here, as you can see, when it's at lows, the S&P isn't really moving that much, and then these huge spikes that happened in February are congruent with the massive spikes in the VIX ETF. You see this huge drop off that happened in February. You can see that the VIX climbed over 400% off this. That means that the VIX does increase with volatility, as you can see off these little moves here. If we pull back a little, all the way back into right here is another perfect example. August 2015, again, massive sell-off in the S&P 500 and a huge spike by the VIX indexes. You can see this huge red line right here. So let's talk about trading the VIX a little, guys. So the VIX itself is optional. There are other ETFs and ETNs that relate to the VIX, which include the VXX, UVXY, but we'll mainly focus on the VIX. So the VIX itself doesn't trade as an ETF, but the options are the most traded actually. So you can buy calls on the VIX when you see that volatility is starting to creep up in markets. You see these moves right here, these little down moves. You could have bought some calls right after this huge red candle here and took advantage of this huge VIX spike. You can also do debit spreads on the VIX. When you expect some kind of volatility in the market, some kind of news event or something, you could write a little debit spread to cap the risk and also cap the maximum return as well. But you have to be careful because, again, volatility can be pretty sporadic, or there might not be any volatility at all. There have been traders in the past who have been banking on VIX calls and just buying VIX calls expecting a huge retracement in the markets, but have oftentimes been unsuccessful because it's very hard to pinpoint those exact moves. And that's because the VIX doesn't really respond to technical analysis. It responds better to fundamentals because, again, it's a measure of implied volatility on an index. So you can't really use technical analysis for this. You can see where the bottoms are and the ranges, but that doesn't really play to your advantage. The huge spikes come from massive moves in volatility, huge drops usually, massive news events that could shake the markets back when Trump and North Korea were going back and forth earlier this year, and even last summer there was a lot of spikes in volatility. So in summer markets, the VIX can be a little harder to trade. Just in general, if you are not expecting a retrace or a huge move in volatility in the index, it can be a little trickier because it's really hard to pinpoint that. But let's go into interactive brokers here and I will show you the options chains right here. As you guys can see, these are the VIX options and this is how to take advantage of the VIX. You can buy calls or debit spreads to take advantage of it. As you can see right here, this is the call side. If you do expect a pop in volatility in the next 70 days, you could go ahead, maybe buy the 11 calls and then sell the 35s or even sell the high 20s for a debit spread, something like that. But again, you'd have to be expecting the massive move in volatility on the S&P 500, guys. So this was a little short tutorial and intro on the VIX. If you guys want to know more, please comment down below, like the video, subscribe, share with your friends. And this was Victoria from TRADEPRO Academy. I hope you enjoyed the short little video.
All right, thank you so much for tuning in. I hope you enjoyed this clip. If you want to learn more about trading options in the volatility index, our swing trader package is full of options education. We teach you how to do market analysis and which option strategies to apply in order to be able to take advantage of the opportunity in front of you. Thanks so much for watching. Please comment, like, share, and subscribe, and we'll see you at our next video. We got a lot of awesome content coming your way. Take care and have yourself a great day.